There are two ways to increase a business's profitability: increase the revenues or lower the expenses. Growing revenues is always great, but sometimes this can be difficult and outside of your control. For example, if something happens to a large client or there is a recession. Looking at expenses, if you're self-employed, one of your largest expenses is likely going to be taxes. The federal tax rate goes up to 37% with potentially additional state or local taxes. However, there is one big advantage that you have as a business owner. You get to deduct a lot of expenses, which can lead to significant tax savings. Let's run through a high-level overview of the tax documents, and then we'll show you how to get the most out of these deductions. The Form 1040 is the main tax document that everyone fills out. Your 1040-ES is what you fill out in the current year to make your estimated quarterly tax payments. The Form 1040 is what you fill out at the end of the year to finalize your taxes owed for last year. The Form 1040 is the headquarters of your tax filing, and it serves as a center of all the forms and attachments. In 2018, the IRS shortened the Form 1040 to make it simpler. As a result, it moved a lot of the information that was previously contained on the Form 1040 to different schedules. Now, you'll likely file a Form 1040 with some or all of these different schedules attached. Schedule C is one of the most important forms, as you can take a lot of business deductions here. Freelancers, people with a side business, or anyone who works for themselves, unless you have an S Corp, will have to fill out a Schedule C with their taxes, which is used to report that business income. There are some exceptions to this. For example, if your business is farming, you'd fill out a Schedule F instead of a Schedule C, but most people will use a Schedule C. Schedule SE stands for self-employed, and is what you'll need to fill out to calculate your self-employment taxes. You'll pay them on the Other Taxes section of your Form 1040. If you're self-employed, you'll likely need to file a Schedule 1. Schedule 1 has two parts. The first part is for claiming certain types of income that are not on your Form 1040. Form 1040 only collects information for the most common types of income. So if you sold a business, for example, you'd need to claim the income from the sale on Schedule 1. Part 2 of Schedule 1 is where you can file adjustments to your income. Most self-employed people will want to take deductions here. This is where you can deduct contributions to a health savings account, or HSA, the deductible portion of self-employment taxes, contribution to an IRA or other retirement savings vehicles, among other things. We have an overview of the other schedules in our library. Once you've filled out these tax forms, you'll be able to calculate your adjusted gross income, or AGI. This is the starting point for all your tax calculations. AGI is the money you made during the year, less above-the-line deductions. The following are acceptable above-the-line deductions: health savings account contributions from Form 8889, deductible portion of your self-employment tax, contributions to a qualified retirement plan, and up to $2,500 in interest on student loans. Once you have your AGI, then you'll take the standard deduction, or if you itemize your deductions, you reduce your AGI by the itemized deduction from Schedule A to arrive at your taxable income. We have more information on taking the standard deduction versus itemizing in the library. Now let's go back to the Schedule C and discuss why this is so important. As a self-employed person, one of the biggest benefits is that you get to deduct a wide variety of work-related expenses from your taxes. This is a luxury usually only afforded to wealthy business owners. It is a huge source of tax savings that you absolutely need to be taking advantage of, and it's why it's so important to keep track of your expenses. On the screen, we have a list of some common deductions that you can take on your Schedule C. Note that you can deduct just about every business expense, including a portion of your rent or mortgage if you work from home. Let's run through an example of how this could help you. First, some simple tax math before we begin. We're showing someone who makes $100,000 a year to keep the math simple. If their tax rate is 35%, they would pay the government $35,000, and they'd keep the remaining $65,000. Next, we've shown some sample deductions they might take that total $13,350. By deducting these, it lowers their business income to $86,650. Assuming the same tax rate of 35%, this results in a $30,328 tax payment for the year. Now let's compare the results if the business owner hadn't taken any deductions. The result is $4,672 in money that stays in the business owner's pockets by utilizing the deductions. In fact, If you know your tax rate, you can multiply that by your total deductions, and that's how much money you'll save each year. This is why it's incredibly important to make sure you maximize these deductions and keep track of all your expenses.